are we sort of today in September of 2010? Well, where we are is, right now there's about 68 to 69,000 properties on the resale market today at the MLS, multiple listing service that the realtors use. I like to refer to the multiple listing services like the large trading pit. It could be like New York, it could be the New York Stock Exchange where people are trading things. You got about 69,000 properties for sale, single family, condo, townhouse. This is in the Tri-County area. This will be Dade County, this will be Broward County, this will also be Palm Beach County. Now, where we started at back in November 2008, when we started tracking this, and we ultimately became, sort of created our benchmark, there were 108,000 properties for sale at that moment in time. Right now, there's about 21,000 pending sales. So you got 68,000 for 68 to 69,000 resales. You have another 21,000 that are currently pending sales. Go back to November 08. November 08, 108,000 properties for sale, 9,000 pending sales. So if you just look at that, you can see the dramatic kind of change in what's going on. But what sort of popped up in recent months, and we started noticing this in May, you're seeing inventory start to increase. In May, inventory fell down to 65,000. We've since added about 4,000 to 5,000 additional units on the marketplace since then. Now, some people say, well, one of the reasons is all the banks are finally unloading. And I should tell you, the banks have filed 250,000 foreclosure filings, which is the initial step in the foreclosure process to date since January of 07, which is when we sort of look at it as the beginning of the bottom, if you will. Of those 250,000 foreclosure filings, it's typically about an 18-month process, costs the bank about $100,000 to sort of repossess or recapture the ultimate property. Of those 250,000 foreclosure filings, 100,000 had gone back to the bank and had been repossessed. So it's roughly about 40%. But if you look at these 100,000 repossessions and these additional 150,000 foreclosures that are in the process, you'll find that only 6% of today's resale market, 68, 69,000, only 6% are bank loan properties. Another 30% are going to be short sales. And the reason the short sale number, which is increasingly going up, short sales are starting to become the new hot thing. And the primary reason is it's cheaper and it's quicker for a bank who ultimately is probably going to get about the same price for a short sale versus an REO. It's much easier for them to move forward and try to move a product in short sale rather than take 18 months to spend $100,000 to kind of do an REO. But that still doesn't make up for the fact that you still have more inventory on the market and these are not deemed to be distressed properties in the multiple listing service, which is a big trade pit. And what we're seeing personally, and I think Oliver will be able to address this, what we're seeing is that there are people who are now starting to come to grips with new pricing. Think back to oil prices. Think back to gas. $1.75 a gallon. And when it went to $4, everybody was outraged. Now suddenly, if you find value in gas at $2.50, $2.60 a gallon, you sort of think like it's good. It's pretty good value. Well, the reverse is sort of happening from what we're seeing from our sellers. If we have a sell-side company, we're seeing that people are coming to grips with the fact that there's a new pricing mechanism that's out there. They probably are going to have to be in their property for a longer period than they ever thought. And now they're starting to come to grips and they're trying to unload this property if and when they can. Now, whether that product's moving or not, that's something Oliver is going to sort of be able to address. In terms of distressed property and where we're going forward, foreclosures primarily, we've seen a 38% drop in foreclosure filings. Right now, in 2010, the first 8 months, we're on pace to do less than 70,000 foreclosure filings. Last year, 97,000. The year prior, 76,000. Year prior to that, 33,000. So as you start to look at all of the graphs, you're really going to see that 08, 09, not to say that it's the bottom, but 08, 09 from a statistical perspective, everything that's being captured is really going to sort of look like things are playing out. So the next question is, well, that's all great, but there's all these unsold condos. What's going on with all these unsold condos? You know, until the unsold condos are absorbed, the market's going to go sideways. We are 2 weeks away from finishing up the final one of our studies. And what we've done is we've gone in and quantified 7 submarkets. And when I say quantified, we set up a physical boundary. We then dug into condominium documents. We extracted information on an apples-to-apples basis, regardless if the building was built in the 1960s or was built in 2010. We put it all into a massive database, and we've been going through and tracking the closings on a what seems like a daily basis, but I think it's a little bit more stretched out. When you say, Carl, who's our research, one of our research guys in the back, what we're finding on the condo side, new condo construction, roughly 23,000 units were built in downtown Miami from 03 to 2010. There's roughly 5,000 left. Of those 5,000 left, 24% are controlled by Starwood, which took over with the FDIC. They took over the Chorus portfolio. Chorus was a large bank. They were the fourth largest lender down here from Condo Construction. They ended up going belly up. The FDIC took them over. They brought Starwood in. Starwood took it over. We sat down with the Starwood guys last week. The days are blurring. Sat down with them last week, and they're taking sort of a stance where you want to pay this price, go to this property. You want to pay that price, go to that property. If you want to pay even more of a premium, go to the other property. So they basically are putting a backstop in. Then you look at what else is available of the 5,000 units in downtown Miami, with 24% being controlled by Starwood. The next biggest pot is going to be HSBC's Tower 1 and Tower 2 of Icon. That'll represent about 14% of the market. The one after that will be Everglades. Everglades is about 700 units, represents about 13% of the market. That is likely to trade by the end of the year with institutional money, who's taking advantage of a new change in the law about successor developer liability. All of the institutional money, and a lot of the institutional money, and we're talking the biggest names out there, are making a serious run at that. And then after that, Related. Related will be the next largest controller, about 9%. And basically what Related has left is scatterings. Product located in this building or that building or this building or that building. Then after that, you get into a situation where it's really just shotgun all around the overall marketplace. So that condo product is really starting to disappear. You jump over to South Beach, there's roughly about 1,200 units left. But that being said, Goldfield traded over there in the second quarter at about $463 a foot. So that's kind of an expensive price. Go up to Sunny Isles, about 1,000 units left in Sunny Isles. Roughly, that represents about 20% of the overall inventory that was constructed. The average price up in Sunny Isles is $475 a foot. Go to Fort Lauderdale, 5,000 units built in Fort Lauderdale based on our boundaries, 200 units left. Go to Hollywood, Hallandale. You go into that marketplace from Federal over to the beach, from Hallandale Beach Boulevard up to I think it was Sterling or Sheridan. You have about 300 units left, and most of them are in the Trump Hollywood project. So you say, boy, this product is disappearing. Let's see what we have in Boca or West Palm. Boca, we're just about finished up, virtually nothing. Go up to West Palm, you got about 1,000 units left out of about 5,000 that tend to be concentrated in a select few buildings. So I guess the case I'm making is a lot of this inventory is disappearing. It's private equity groups who are coming in because of cheap currency, because of the fact that they can buy below replacement costs. But ultimately, at the end of the day, this product, even if they rent it, they're able to command a nice price. They're not going to be breaking even if there's any debt. They'll make somewhat of a return if they're buying simply cash on cash, if they're taking that perspective. So, the argument can kind of go both ways. Are we at a bottom? Is the market stabilizing? Is it not stabilizing? Is there going to be a double dip? And I'm going to let that answer basically be provided by our esteemed panelists.